Unfortunately, our emotions are something that we are all susceptible to, but it's very important to disregard them in the world of trading. For instance, suppose you place a trade and it starts showing you a profit. A lot of people may act on this impulse and lock in their gains immediately, but oftentimes the right thing to do is just to let that trade develop.
A new silver company for investors, with Keith Neumeyer agreeing to become a major shareholder. Luke Norman, co-founder of Gold Standard Ventures, is the new chairman, and the company has acquired 3 former First Majestic silver properties. To learn more about this must-own silver stock, go to futuremoneytrends.com/silver1. That's futuremoneytrends.com/silver1.
Hello, everyone, and welcome into crushthestreet.com. I got on the line today David Trungale of TraderTours.com. This is a guy who's got a pulse on the market. He's got a great subscription service that simply, he focuses on profiting from, what the market is doing, what the, specific trades are doing. He's not emotional when it comes to his trades. He's focused strictly on profiting. But, I want to get his thoughts. He's had some very interesting takes on, in the past on precious metals and, where the stock market is going. So David Trungale, thanks for coming on the show with me today.
Kenneth, it's a pleasure. Thank you for having me back.
David, we are on the verge of hitting Dow 20,000, and it seems like we got some resistance here. We're not seeing the Trump effect blow through that ceiling, what it appears to be a ceiling here. So any thoughts on your end as to what we're seeing, from a technical perspective or even a fundamental perspective with the stock market?
Yeah, I agree with you that it does appear that there is some resistance. I mean, Dow 20,000 is certainly a big number. And if you look at the historical record, when the Dow hits round numbers such as 16,000, 18,000, or 20,000, it does tend to cool off. In fact, again, 18,000 Dow, it hovered around there for nearly 2 years. We had the volatile swings back over the summer. And now here we are penetrating above new highs. So yeah, we did break the resistance at 18K. But I do think that this is an aging bull market still. And just looking at things from a perspective of cycles, the deeper you get into the bull market, the way I approach it rationally is to just shave off more profits and be more conservative, because the odds of the bull market continuing begin to dwindle the longer you go into it. I mean, like I said, this is the second longest bull market in history, the only exception being the 90s, which surpassed this one, but we're getting there. So I think that the real opportunities going forward are in individual securities and individual trades. I would be a little bit leery of investing in indexes at this point. And that's kind of where I'm at right now. And not a whole lot has changed for me. I know I kind of sound like a broken record, but you have to take the market for what it is and avoid the media at all costs.
Interesting. I mean, you did point out that, hey, the market is going in a bullish direction the last time we spoke. And now you're saying, hey, we're getting pretty deep in this bull market here. And so do you think that it's just getting to unsustainable territories, and what could cause it to go in the other direction? What are your thoughts on it? Is it going to be a major sell-off or some sort of trigger? Any thoughts on that?
Sure. Well, markets move based on buying and selling pressures. And the first thing I would look for is selling, because selling leads to more selling. Buying leads to more buying. It's a momentum thing. So I would be looking for a pullback, and that could trigger more selling. There's moving averages that I like to use. Again, Ken, my background. I'm a technician. So I don't really pay attention to valuations or the media or earnings. I'm looking at things from a 100% technical perspective, because that is what has worked for me over the long haul. So yes, if you look at the consolidation and the choppiness back in 2015 and 2016, that was a similar pattern to what we saw before the '08 crisis and even the dot-com bubble. But, I'm not quick to try and forecast an immediate crash. Not many analysts talk about the possibility that markets can simply go sideways for a long time, but that's not something people talk about, because what gains the attention of the viewing public is extremes. If you look at the Dow, though, from 1966 all the way to 82, it really didn't go anywhere. It was hugging around 1,000, and throughout all those years, there were people talking about a bull market and a bear market. Well, the reality was it was a neutral market. So keep in mind, markets can go up, down, and sideways. I know that sounds pretty rudimentary, but a lot of people don't make the accurate observations.
Sure. David, when it comes to precious metals here, we've seen the pullback since summer of 2016, but we're seeing a resurgence here going into the new year. The last couple trading days have been pretty strong for gold and silver. What does this mean to you?
Well, I've been on here a number of times. In fact, my reputation goes back for quite a while. I was known for capitalizing on the silver collapse. I sold short for many, many years. And then, of course, we did have that pretty notable rally in 2016. A lot of people thought the trend had changed. I was kind of on the fence myself. I made it clear that I haven't been shorting metals anymore, but I'm not buying them either. You know, it still looks like it could be a bear market rally. I kind of have mixed views on that as well. Like I said, another possibility, it's a neutral market. Silver's at about 16 or 17 an ounce now. Where was it a year ago? 16 or 17 an ounce. So the word imminent or the word up or down, it doesn't mean the same things to me as it does other people. I'm not afraid to come on here and say that things may just kind of stay where they're at. Again, I know that's not a huge selling point, and a lot of people are always thinking up or down. Well, again, after something collapses from a high point, there is a very high probability that the market will continue to consolidate. That's usually what happens after a long bear market or bull market. So my take on metals, I'm not buying them. I'm not selling them. I think there are better opportunities and better trades to make out of that sector. But I fully do come forward and say that, yes, the big opportunity to clean up shorting metals was from 2011 all the way until 2014 or 15. That big time shorting opportunity is probably over. But again, I don't necessarily think that it's a great buy either.
Well, yeah, time will tell on that for sure. Let's talk about trading, David. You are a successful trader, and your track record proves that. You've been able to trade successfully, and I know you have some advice for all the listeners on how to do that. And I'm sure the tips that you have are helpful across the board, whether you are, more of a day trader, which I know you don't consider yourself a day trader, or, a long-term investor. So let's get into some of these topics here going forward and how to be a successful investor in the market.
Well, sure. I mean, first off, I always tell people to, like I alluded earlier, to avoid the news. Remember that reporters are paid up to fill their papers even when nothing is going on. So what makes the headlines usually is, Dow soaring, metals soaring or collapsing or whatever. But like I said, it's pretty plausible that these markets can continue to move sideways. They're not that exciting, but that doesn't sell to an audience. But remember, our goal as a trader should be to make money at all costs, regardless as to how exciting or how boring the markets are. So avoid the news, come to your own conclusions. That's one critical tip. Another one, eliminate emotion as much as possible. Unfortunately, our emotions are something that we are all susceptible to, but it's very important to disregard them in the world of trading. For instance, suppose you place a trade and it starts showing you a profit. A lot of people may act on this impulse and lock in their gains immediately, but oftentimes the right thing to do is just to let that trade develop. And one of my rules is that I will never sell a rising stock when I go long, and I will never sell a short position if the security is continuing to fall. So again, every decision should be executed for a reason. You shouldn't be trading for fun or to impress your friends or just because you feel like it. Your goal should be to make money. And I also think that theory kind of runs into the general business world and life as well. Suppose you were to open up a restaurant and you were looking to hire someone as a general manager. Well, if you have two candidates, one of them's your friend who's not qualified, but you have this connection with, and the other is somebody you don't know who's a better fit for the job, you should hire the person that you don't know is a better fit, right? I mean, you got to look at their skill set and take emotion out of the picture. Lastly, the tip that I would leave the audience with would be to cut your losses when you can. And now when I say stocks, I'm also referring to securities and commodities. I kind of use those words interchangeably, but you got to remember that if you are in a position and the stock falls, as it falls more, it gets exponentially more difficult to recover. For instance, suppose you buy something and the stock falls 50%. If I were to ask you how much would it need to rise in order to return to its original price, a lot of people jump the gun and they say, well, if it's down 50%, it needs to go up 50% in order to break even. Well, that's not accurate. It actually would need to go up 100%. If you think about it, if a stock goes from 20 to 10, that's a decrease by half. But from 10 to 20, that's an increase of 100% or doubling. And it only gets worse from there. If a stock goes down 90%, it actually has to go up 900% to break even. So it gets mathematically more difficult to recover. The rule that I use, I generally cut my losses somewhere around 10%. If it goes down 10%, it only needs to go up about 11% to break even. That rule, though, does not have to be set in stone, especially for trading derivatives because of their volatile nature. But nonetheless, it's something that I do follow.
What would you say about averaging down then if you were going to do that? Because obviously when something does go down by half or, whatever, by more, buying at those prices gives you, the upward mobility to be able to regain your losses at a lower price than it fell from, right?
Well, that's true. And, with every approach that you take, Ken, there's going to be a certain degree of a trade-off. I mean, again, I'm not a big fan of averaging down or dollaring down because of the reasons I stated. It gets a lot more difficult to recover. And a lot of times things simply don't come back. I mean, like I said, if you look at the silver market and the catastrophic hit it took since 2011, we're still a really, really long way from the 2011 highs. But, there can be times when averaging down does work. If you look at Netflix, for example, it had a huge collapse in 2011. Everyone said the bull market was over, and then it rebounded all the way back up through 2013, set new highs, and now we're over double the price that we were even then. So I don't like to dollar cost. I think that you are increasing your loss exposure, you're increasing risk, and I'm a big fan of mitigating my risk. But like I said, there are other strategies that are equally as valid as mine. You don't necessarily have to follow what I do in order to be successful. If you look at some of the fundamental giants out there like Warren Buffett or Jim Rogers, they've obviously done very well by dollaring down or investing based on fundamental theory. For me, I'm a technician, so I prefer to stay away from that particular strategy.
Yeah, I mean, excellent thoughts on that. And, even the perspective, obviously a lot of people that come on the show, we're pro metals, we talk about the economy a lot more, and your perspective on things is a little different, but it's definitely worth listening to. And maybe some might disagree with the way you approach or are thinking about precious metals, but even being able to hear that side of the equation is still important and still valid for moving forward and understanding how to approach the markets. And so David, any final words of advice that you would have for people? And if you would like, please share some more information about the services that you provide at tradertours.com.
Sure, I'll leave you guys with one final tip here, and then I'll talk a little bit about the website and what I do. The final tip that I would leave the audience with would be to buy on strength and sell on weakness. And that's another rule that can be a little bit ambiguous. In general, though, I won't go long on something unless it is up on the very day that I buy it. It has to be in the green. And conversely, I won't sell something unless it's going down or it's in the red the day that I short it or I take a profit. Now, again, as I've mentioned before, though, you have short-term trends, intermediate-term trends, and long-term trends. So suppose hypothetically we have a 3-year chart that's in a bullish pattern. Well, that's long-term strength. But within that trend, you might have bull market dips that go down for a month or two. So maybe it would pay to wait for a bull market dip, and then you still need to wait, though, for strength or confirmation that you're going back upwards, and then you can buy in. Then again, though, some people have done very well. I know I've had a few trades in the past that have done well where I'm buying when something sets a totally all-time high, a totally brand new high, and you're not really waiting for a pullback. So it depends on the market conditions, but you can also do well by buying on resistance breaks. But bottom line, you should be entering on an up day, and you should be selling on a down day. And as far as my website, tradertours.com, again, we specialize obviously in trading and information. I'm a big believer in, learning by doing. We put out market updates. Also, there are guidelines to investing and specific chart patterns that I include in the emails. So everyone can check it out at tradertours.com. You also have full email support from myself.
Awesome. Well, everyone, David Trungale of tradertours.com. David, thanks for coming on the show with me today.
Thank you again, Kenneth.